Preparing for a private credit fund accounting, the fastest growing asset class interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What makes private credit fund accounting different from private equity or hedge fund accounting? The interviewer wants to assess whether you understand the unique accounting profile of private credit funds, including loan income mechanics, Level 3 valuation, investor reporting, and differences from private equity or hedge fund workflows. While answering, focus on recurring interest income, loan-specific terms, PIK, OID, unfunded commitments, fair value estimates, borrower credit monitoring, NAV production, and investor allocations under the fund documents. Private credit accounting sits between loan operations and fund accounting. Unlike private equity, income accrues every period through interest, OID, PIK, and fees. Unlike liquid hedge funds, many assets are Level 3 and need valuation support. I would focus on accurate position setup, cash and accrual reconciliations, covenant or default flags, NAV impact, and investor allocation rules. The accounting has to capture both current yield and credit risk. Question 2. Walk me through the accounting lifecycle of a direct lending loan, from funding to repayment. The interviewer is testing your understanding of the end-to-end accounting lifecycle for a direct lending investment, from funding and accruals through valuation, amendments, repayments, and realized gain or loss recognition. Make sure to cover initial recognition, principal funding, OID or fee treatment, periodic interest accruals, PIK, fair value marks, cash reconciliations, and accounting entries upon partial or full repayment. On day 1, I record the loan at funded principal adjusted for OID, transaction costs if applicable, and any upfront fees under the fund's policy. Each period, I accrue coupon interest, amortize OID or fees using effective yield if required, record PIK additions, and reconcile cash receipts. At quarter end, I support fair value marks. On repayment, I clear principal, recognize any remaining unamortized discount or premium, and book realized gain or loss. Question 3. How do you account for PIK interest in a private credit fund? The interviewer wants to assess your grasp of payment-in-kind interest, accrual accounting, principal capitalization, income recognition, and the credit implications of borrowers choosing non-cash interest settlement. In your answer, talk about accruing PIK income, increasing loan principal or cost basis, compounding effects, collectibility assessment, valuation impact, and why PIK can be a credit warning sign. PIK interest is interest paid in additional principal rather than cash. If a $10 million loan has 8% cash and 4% PIK, I accrue the cash interest receivable and add the PIK portion to the loan balance. Assuming collectibility, it's still supportable. That increases invested cost or principal for future interest calculations. I also watch valuation and impairment because high PIK usage can signal liquidity pressure at the borrower. Question 4. How should OID and upfront fees be treated in private credit fund accounting? This question evaluates your understanding of yield economics, effective interest methods, discount amortization, fee classification, and the importance of consistent accounting policy across similar credit investments. Be sure to mention original issue discount, amortization into income, effective yield, treatment of upfront, amendment, or commitment fees, documentation review, and avoiding inappropriate day 1 income recognition. OID is a discount to par that economically increases the lender's yield. For example, funding 98 on a 100 loan means the 2-point discount is recognized over the expected life, often through effective interest amortization. Upfront or amendment fees depend on whether they are yield enhancements, service fees, or transaction economics. I would align treatment with the governing documents, accounting policy, and administrator process so NAV income is not overstated upfront. Question 5. How are private credit investments valued when there is no active market price? The interviewer is testing your knowledge of Level 3 fair value measurement, valuation committee support, market yield calibration, borrower performance analysis, and accountant responsibility for booking approved marks. While answering, focus on observable inputs, spread movements, credit quality, EBITDA trends, covenant headroom, comparable yields, recovery analysis, valuation governance, and unrealized gain or loss recording. Private credit marks usually combine observable market inputs with borrower-specific analysis. I would start with recent transaction price, then consider spread movements, benchmark rates, leverage, EBITDA trends, covenant headroom, payment performance, and comparable loan yields. For stressed names, recovery and enterprise value analysis matter more than simple yield calibration. The accountant's role is to book approved marks, tie support to valuation committee files, and ensure unrealized gains or losses flow correctly through NAV. Question 6. What happens in the books when a borrower goes into default or is placed on non-accrual status? The interviewer wants to assess whether you understand income collectability, non-accrual accounting, accrued interest reversals, default monitoring, valuation coordination, and prudent NAV reporting for impaired credit positions. Make sure to cover stopping income accruals, reversing questionable receivables, tracking contractual interest separately, cash application policies, fair value impact, impairment indicators, and documentation of credit events. When a borrower goes non-accrual, I stop recognizing interest income that is not reasonably collectible. I reverse or reserve unpaid accrued interest if policy requires. Continue tracking contractual interest off ledger and coordinate with valuation on expected recovery. Cash received may be applied to principal or recognized as income, depending on the credit assessment and policy. The key is not letting accounting income imply performance that the credit facts no longer support. Question 7. How would you validate interest accruals on a floating rate private credit loan? This question evaluates your attention to loan terms, SOFR-based rate resets, day count conventions, rate floors, agent notices, accrual calculations, and reconciliation discipline during the NAV close. In your answer, talk about base rate, spread, reset dates, observation conventions, floors, step-ups, principal changes, day count, agent statements, cash receipts, and administrator recalculation checks. Most private credit loans are floating rate, so interest accuracy depends on rate resets. I verify the base rate, spread, day count convention, reset date, look back or observation shift, floors, and any step-ups. For a SOFR plus 650 basis point loan, a small rate setup error can materially distort income across investors. I would reconcile administrator accruals to agent notices, loan system data, and cash receipts before finalizing NAV. Question 8. How are capital calls and distributions accounted for in a closed-end private credit fund? The interviewer is testing your understanding of commitment-based fund structures, investor capital accounts, drawdowns, distributions, equalization, recycling provisions, and LPA-driven allocation mechanics. Be sure to mention commitments, capital call receivables, cash collections, investor-level allocations, return of capital versus income distributions, defaulting investors, recycling, and remaining unfunded commitment tracking. Capital activity drives both liquidity and investor ownership, so timing matters. For a drawdown fund, I record commitments, capital calls, receivables, cash collection, and investor capital accounts by class or series. Distributions may represent income, return of capital, or realized proceeds under the LPA. I would check equalization, defaulting investor provisions, management fee bases, and whether recycling is allowed, because each affects remaining commitments and future allocations. Question 9. How do management fees and incentive fees typically work in a private credit fund? The interviewer wants to assess your ability to read fund documents, calculate fee accruals, understand hurdle and catch-up mechanics, and connect fee accounting to investor allocations. While answering, focus on commitment-based fees, invested capital or NAV-based fees, fee offsets, carried interest, incentive allocations, hurdles, catch-ups, loss carryforwards, and LPA-specific calculations. I read the LPA first because fee mechanics are document-driven. Management fees may be based on commitments during the investment period and invested capital or NAV afterward, with offsets for deal fees. Incentive fees can be carried interest, performance allocation, or subordinated income distribution, often subject to hurdles, catch-ups, and loss carryforwards. My accounting focus is calculating the accrual, allocating it to investors correctly, and reconciling it to waterfall models. Question 10. How does fund-level leverage affect private credit fund accounting and NAV reporting? This question evaluates your understanding of subscription lines, NAV facilities, interest expense accruals, deferred financing costs, covenant reporting, leverage ratios, and the impact of borrowings on investor returns. Make sure to cover recording debt, accrued interest expense, unused fees, financing cost amortization, cash reconciliations, collateral reporting, covenant compliance, leverage disclosures, and gross versus net performance impact. Fund-level leverage adds another layer to NAV. I would record borrowings, interest expense, unused commitment fees, deferred financing costs, and covenant reporting requirements. With subscription lines, the facility may bridge capital calls. With NAV facilities, collateral is the investment portfolio. Accounting has to match borrowing costs to the right period and entity. Operationally, I reconcile lender statements, cash movements, and leverage ratios, because errors can affect compliance and investor reporting. Question 11. How do you account for unfunded commitments on delayed draw term loans? The interviewer is testing your knowledge of funded versus unfunded exposure, off-balance sheet commitment tracking, ticking fees, liquidity management, disclosure requirements, and credit agreement reconciliation. In your answer, talk about recording funded principal, tracking unfunded amounts, accruing commitment or ticking fees, reconciling to notices, assessing fair value, and disclosing remaining obligations. A delayed draw term loan creates both a funded asset and an unfunded commitment. I record funded principal as the investment and track the unfunded amount in commitments, with fees accrued if the borrower pays ticking or unused fees. The unfunded exposure may require disclosure and can affect liquidity forecasts, borrowing-based calculations, and fair value. I would reconcile it to credit agreements and agent notices, not just the general ledger. Question 12. What key metrics should be tied out in private credit investor reporting? The interviewer wants to assess whether you understand how accounting data supports investor communications, performance reporting, portfolio analytics, exposure reporting, and consistency across NAV statements and investor letters. Be sure to mention NAV, capital accounts, income yield, realized and unrealized gains, funded and unfunded exposure, leverage, fees, IRR, distribution yield, concentrations, and financial statement consistency. Private credit investors care about both yield and downside protection. In reporting, I would tie NAV, income, realized and unrealized gains, funded and unfunded exposure, leverage, and fees to the books. Performance metrics may include net IRR, gross IRR, distribution yield, loss ratio, and asset level concentration. The accounting team must ensure these numbers are consistent across financial statements, capital account statements, and investor letters every quarter. Question 13. You find an interest income break between the administrator and the agent notice. How would you investigate it? This question evaluates your practical problem-solving skills, reconciliation methodology, knowledge of loan terms, ability to isolate errors, and judgment around NAV adjustments or escalation. While answering, focus on comparing accrual formulas, rate inputs, day counts, principal balances, settlement timing, PIK, paydowns, amendments, cash receipts, documentation, correction entries, and materiality assessment. I would isolate whether the break is timing, rate setup, day count, principal, or cash application. First, I compare the administrator accrual to the agent notice and loan agreement. Then I check trade date, settlement date, paydowns, PIK capitalization, rate floors, and amendment terms. If the fund received cash, I trace bank activity. Once identified, I book the correction, document the cause, and assess whether prior NAVs need adjustment. Question 14. Under US GAAP, why do private credit funds usually report loans at fair value rather than amortized cost? The interviewer is testing your understanding of investment company accounting, ASC 946 concepts, fair value measurement, NAV reporting, and the distinction between income accrual schedules and balance sheet measurement. Make sure to cover investment company status, fair value reporting, Level 3 measurement, investor NAV needs, amortized cost schedules for yield calculations, and unrealized gains or losses. If the fund qualifies as an investment company under ASC 946, its investments are generally measured at fair value, even when the legal instrument is a loan. That surprises people who think loans automatically sit at amortized cost. The fund's business model is investing for returns through income and appreciation, with periodic NAV reporting to investors. Amortized cost schedules still matter for income calculations, but the balance sheet reflects approved fair value. Question 15. What controls would you prioritize in a month-end or quarter-end close for a private credit fund? The interviewer wants to assess your control mindset, close process discipline, reconciliation priorities, audit readiness, valuation evidence, and ability to protect NAV accuracy under deadline pressure. In your answer, talk about position reconciliations, cash reconciliations, interest recalculations, valuation approval support, expense accrual review, investor allocations, leverage checks, exception tracking, and sign-off controls. In a month-end close, I prioritize completeness, accuracy, and evidence. I would reconcile positions to agent or custodian records, cash to banks, interest to notices, and valuations to approved mark files. Then I review expense accruals, management fees, investor allocations, leverage, and financial statement classifications. Strong controls include maker-checker review, stale price checks, exception logs, and sign-offs. That discipline protects NAV and builds confidence with auditors and LPs. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.